In the wake of the U.S. presidential election, financial markets initially rallied, optimistic about the prospects of a business-friendly presidency under Donald Trump. However, Trump's subsequent aggressive tariff policies quickly shifted market sentiment, causing significant disruptions. Trump's administration introduced steep tariffs aimed primarily at reducing the U.S. trade deficit, protecting domestic industries, and asserting economic dominance globally. President Trump believed strongly in tariffs as a mechanism to revitalize American manufacturing, bolster domestic employment, and level what he perceived as unfair trade practices by other countries. Trump argued that tariffs would make imported goods more expensive, thereby encouraging consumers to purchase American-made products. He asserted this would stimulate the U.S. economy, increase domestic production, and restore economic balance with trading partners, particularly China, whom he consistently accused of exploiting trade agreements at the expense of American jobs and businesses. Initially, Trump's proposals involved moderate and targeted tariffs in his first term. But following his re-election, the administration dramatically intensified its protectionist measures. Broad-based unilateral tariffs were enacted, imposing at least a 10% levy on all exporters to the U.S., with even higher rates against approximately 60 specific countries. These measures represented the most significant tariff imposition by the U.S. in roughly a century, signaling a pronounced shift away from globalization toward economic nationalism. The introduction of these tariffs quickly rattled global markets. U.S. equities suffered severe losses, with the S&P 500 plummeting nearly 5% in a single trading session, marking the worst decline since 2022. This sudden downturn contrasted starkly with the bullish optimism at the start of Trump's second term, when Wall Street projected strong economic growth buoyed by promised deregulation and further tax cuts. Against this backdrop emerged Peter Berezin, chief global strategist and director of research at BCA Research. In December 2024, while Wall Street celebrated the prospects of economic growth under Trump, Berezin sounded an early warning. He predicted the Trump administration would enact broader, more aggressive tariffs, leading to significant economic instability. Berezin's forecast, initially considered overly pessimistic, proved prescient as Trump's aggressive tariff strategy unfolded exactly as he anticipated. Berezin accurately foresaw the broad negative impact tariffs would have, from immediate market losses to longer-term economic pressures. He notably predicted that the S&P 500 would drop significantly, potentially reaching as low as 4,150 by year's end, an 18% decline from its current position. Additionally, he forecasted that oil prices would fall sharply from $63 to $50 per barrel, driven by declining demand as economic activity slowed. More critically, Berezin now warns that the probability of the U.S. entering a recession stands at a daunting 75%, potentially beginning as soon as the second quarter. His analysis emphasizes multiple vulnerabilities already present in the U.S. economy prior to the tariff shocks. Factors such as dwindling pandemic-era savings, rising vacancies in commercial properties, fewer job openings, and increasing delinquencies in auto and student loans had already weakened the economy's resilience. According to Berezin, Trump's aggressive tariffs act as a powerful negative catalyst, exacerbating existing weaknesses. The tariffs are expected to trigger international retaliation, with other countries potentially imposing taxes on U.S. companies operating abroad, particularly in the technology sector. Additionally, Berezin anticipates a damaging global reaction, including boycotts of American products and a reduction in international tourism to the United States. Further complicating matters is the domestic impact of these tariffs. Berezin describes the risk of a vicious feedback loop, where anxiety induced by economic uncertainty prompts consumers to curtail spending. Reduced consumer spending leads to fewer business revenues, resulting in decreased hiring and layoffs. This cycle perpetuates itself as declining employment further reduces consumer confidence and spending, ultimately deepening the economic downturn. Berezin also highlights the danger posed by potential unfunded tax cuts promised by the administration. Such policies could lead to prolonged elevated treasury yields, increasing borrowing costs, and creating further economic headwinds. In sum, the cumulative impact of retaliatory international trade measures, decreased consumer confidence in spending, and broader financial market disruptions are poised to push the U.S. economy into recessionary territory, validating Berezin's grim forecast. While Trump's original intention behind tariffs was to bolster American economic strength and protect domestic industries, Berezin's analyses suggest that these aggressive trade measures might ultimately trigger the very economic weaknesses they sought to avoid.